Hello, I'm Nick Axford, Head of Research, CBRE in Asia Pacific. Joining me today to talk about the prospects and performance of the Hong Kong market is Ed Farrelly, our Head of Research here in Hong Kong. Ed's been with the company quite a few years, previously responsible for our research activities in Spain before moving out to Hong Kong a couple of years ago. Ed, let's spend a little while just talking through what we see happening here in Hong Kong, and perhaps let's start with sort of the economy and what we see happening from the demand side.
Sure, thanks, Nick. I think looking at the economy, it's interesting when we look at some real estate sectors in Hong Kong, there is a certain decoupling between economic activity and what the market is doing. Residential springs to mind, but that's not the case with the office market. The economic activity has taken a downturn during 2012. We're looking at the year finishing off with GDP growth of around 1.2%. Now that's coming off rates of about 5% in years past. Now there is a very strong correlation between this and net absorption. If we delve down into GDP and look at business sector growth, the correlation between that and net absorption is, well, for those of you statistically minded, it's about the R-square is about 0.958, so it's probably as good as you're going to get. So going forward, we expect things to pick up during 2013, depending on who you're talking to. Government estimates come in at about 2.5 to 4.5% in GDP, and that should feed into a stronger performance in the office market. Just a couple of things to point out in regards to demand and what demand is doing. Companies are a lot more cost conscious. They're moving to more cost efficient areas, and we see the Kowloon in particular benefiting from that. However, net absorption is about half of what we would normally expect looking at the long-term average. But yes, that is going to increase, I think, going forward through the year.
But nevertheless, we are seeing vacancy generally still on very much a downward trend.
Absolutely, and I think that's one of the interesting things about the market. Even though we've got demand, which is half of what we normally expect, vacancy still is being driven downwards. Now, we can split that up between sub-markets. If we look, for example, just in a very simplified way, between the core CBD and decentralised areas. Core CBD in central, yes, it has seen an uptick in vacancy. It's in around 5% now. I think to a certain extent we get carried away when we're talking about an increase in vacancy in central. Yes, it's only 5%. That is below its long-term average again. So in the general scheme of things, it's not a lot, but it is a lot more than what we see in other markets, or other sub-markets in Hong Kong. A lot of these sub-markets in decentralised areas are operating on vacancy rates of 1.5, 2%.
But still not a huge amount of space in absolute terms, and a lot lower than we see in many other markets around the world. Yeah,
absolutely, and you know we can slice and dice this information any way we want, and the result is the same. There's not a lot of space out there. It's interesting to note that if a company is looking for a building with more than 25,000 square feet of available space today, there are only 22 of those buildings throughout the market. Now again, only 2 of those buildings are available at a rent of less than $50. So we have seen how demand is shifting to these cost-conscious areas, or cost-efficient areas. But companies are looking for cheaper space, but in many times they're not able to find it. Now that has got other implications in regard to what companies are looking to do, whether purchase office space or move into areas which were not normally on their radar.
But I mean, I think the key thing that differentiates Hong Kong from so many other markets is the future supply picture, which really isn't going to offer occupiers much relief.
No, you're absolutely right. We're coming off, as I say, a very low vacancy rate now. The starting point is 3% going forward. And over the next number of years, we don't see a lot of space coming to the market. Again, if we look towards the long-term average, normally we would expect in and around of 2 million square feet per year. We're only going to get an average of 1 million square feet through to the end of the decade. So just looking at that would suggest that there is a shortfall. Now we've recently completed a study together with Iowa Capital Markets, and that was the outcome of this study suggests that there will be a shortfall in terms of new office supply in Hong Kong of 9 million square feet by the end of the decade. That's if Hong Kong produces economic growth that would maintain its world city status.
Mm. So clearly, you know, there's almost an inevitable implication for rents at some point, and yet at the moment we're seeing rents, certainly in some parts of the market, declining. How are you seeing the evolution of rents going forward?
Well, again, I think in regards to rents, the same as we've done with demand and vacancy, we need to split the market up into various areas. And again, just looking at it in terms of central and decentralised areas, We still do see rents in Central suffering to a certain extent, particularly during the first 6 months of 2013. Perhaps some stability going forward. Now, the reason for that, I think, is secondary space coming to the market. There are some emblematic buildings which house a number of larger companies, and they're looking to downsize, they're looking to surrender space, sublet space, and that will impact on Central rents. So I think we will see some turbulence over the next 6 months. Perhaps some stability going forward, but certainly the platform for rental growth beyond that is very strong. In regard to decentralised areas, we still will see rental growth throughout this year. For example, areas in Kowloon, for example, showed rental growth of 10% last year when demand wasn't particularly strong across all the market. I did reference demand shifting towards these areas, and I think that will continue this year. If we look at the sectors that are looking to expand, insurance, retail, product sourcing, all of those sectors show a preference to be in decentralised areas. Having said that, I think the rate of growth may decline because there is a certain convergence between different submarkets, and that will impact on the potential for rents to keep ploughing ahead. That's for 2013, but as I say, the platform for rental growth 2014 and beyond, I think, is very strong, given the benign pipeline supply scenario.
And clearly we're seeing very strong interest and activity from a property investment point of view in the market. The key question, I guess, is, is it justified? I mean, you say there are strong fundamentals, but we're also seeing extremely strong investor interest.
Well, it's a great question. We do see a lot of money coming into the commercial property market, and there certainly are risks there, undoubtedly. Yes, we do see a broad base of investors, but some of these investors are coming across from the residential market. The government they've changed their policy in the residential market. They've introduced cooling measures. They banged a 15% tax on for foreign purchasers, essentially. So these purchasers are looking towards the commercial market. So we've seen situations where parking spaces have been sold in a question of hours. The latest thing now is certain hotels being sold off room by room. So any real estate product that's been put on the market really has been snapped up. So that would, to a certain extent, trigger some alarm bells in terms of if there was an external shock going forward, how would the market be able to cope with this? And certainly it would be susceptible to a shock. However, over the coming months and quarters, demand certainly is sufficient to keep these levels going forward.
Absolutely. I think there's some potentially some medium-term questions, but short-term looks as though we're set for a pretty strong investment market during most of 2013.
Yeah, absolutely. I think we've seen deals going through. The latest deal is in a decentralised area in Kowloon, 3 billion Hong Kong dollars spent on an office building at a yield of in around 3%. And as I say, now this is an example of a non-block purchase. Strata title market is very, very strong at the moment. So we do see a weight of capital looking for a home in Hong Kong, and that should keep volumes ticking over the coming quarters.
Great. Thanks very much, Ed. I'm afraid that's all we've got time for today. Clearly a lot more to talk about in terms of the Hong Kong property market. If you're interested, please do feel free to either get in touch with Ed and the team directly, or alternatively take a look at the numerous publications that we have available on our website. This podcast, along with many other presentations and video recordings, is available on cbre.com or through various other media channels. Thank you for joining us, and I hope you'll join us again soon. Thank you.